Hello, Jens. How are you?
Hello, Theo. I'm doing great. How are you?
I'm very good, very good. Always pleasure when I see your smiley face.
That
was nice.
What shall I say? That was probably the nicest thing I've ever heard the whole week.
Yeah.
At least. So my kids are not as nice as you are to me. My wife, well, let's talk about this.
So it's always good to have good friends around, huh?
Yes. It's well, I love these events. Let's do them more often. I think that this is a good plan. So it will lift my overall mood.
Nice. So I think everyone is ready for you and excited. I see a lot of participants this afternoon, so it's fantastic actually.
Yes. So we want to have a look at a very fascinating topic, I think. So ECB rate decision. It's 2 weeks still, but
yes.
And surprisingly, so usually we would talk about the non-farm payrolls today. It's the first Friday of the month.
Yeah.
But it's next week for whatever reason. I think it's because of some, I don't know.
I think usually when a Wednesday or Friday, it's until the 3rd of each month. If it's Friday, then they move it to the next one, something like this.
Well, the thing is, I just thought that if this is the case, that might make sense. But then I think we also had a non-farm payrolls release once at the 1st of the month or something like that. So, well, whatever the reason is, so we can still talk about the ECB today.
Very interesting and exciting topic.
Yeah, I hope so. So, especially since in the morning,
I will let you start. Good luck.
Yeah, thank you. Thank you too. Because in the morning, I came across a very interesting chart, in fact, I want to share with you. It's in regards to a massive acceleration in terms of bankruptcies over here in Germany. For example, today, I probably, you're not familiar with Peek and Kloppenburg, but it's a very big brand in Germany. And in fact, you can, or usually if you buy a suit, let's say, and it's not made to measure or it's not bespoke, then usually head over to P&C. And so, they just said, well, they're insolvent. So there's many companies, also big ones, well known ones, going bankrupt right now, which is in fact no big surprise. So everyone could have seen that coming. With a tight approach from the ECB, in addition with not just the ECB fighting inflation by hiking rates in a very aggressive manner, but also in addition with the current deindustrialization taking place over here in Germany, with the politicians sanctioning Russia over its invasion in Ukraine, and resulting in a very massive spike in energy prices. Very important aspect for industrialized countries like Germany, and it's in fact the business model of Germany. So long thing short, it's the reason why Germany is or has been at least for the last 10 years at least the engine of the European economy, was due to cheap fossil fuels, due to cheap energy, which was then used to produce goods of a high standard and exported into the world, and was needed. And now most of these companies just go broke because or go bankrupt because they can't afford producing at this rate, can't afford this with elevated energy prices anymore, and this is accelerating now. But long thing short, so this is a chart I will show you in a few seconds in regards to the rate decision, and we also want to look back at what the Fed, I'm sorry, not the Fed, the ECB delivered last month at the first, I think, second. It was the 2nd of February at the last rate decision. So it's 6-week intervals in which they then head over to the next rate decision. Very important to note before we start that we will also go through the charts and we will also look at Euro USD, for example, but also probably have a look at the DAX, which is currently very strong. So especially after yesterday. So in fact, I had a trade open. I can go through this trade probably, and then my idea behind this. And we flushed out on the downside, but didn't break below 15,200. Instead, now reversing and about to break above 15,500, closing the week above that level. Let's see what the Wall Street delivers. But all in all, it's a surprisingly strong environment in which we find ourselves. Probably it's due to especially the producer price index, which was released today and coming in below expectations, and then fueling expectations around a more dovish stance probably from the ECB. Probably that's the reason. That's also probably the reason, one of the reasons why Euro USD is currently dropping and right now attacking the region around 106. But long thing short, first of all, let's have a look at the risk disclaimer here. It could be that we are formulating a trade hypothesis that I make trades a potential topic here in the webinar. And please be sure that you understand that, first of all, trading involves risk, especially once we trade leveraged products, as we do. There's a risk of losing money. And then everything I present to you here is not to be misunderstood as financial advice, but it's just for educational purposes only. So if you plan to take a trade based on my ideas and based on the game plans I showed you, please make sure that you understand that you take full responsibility for your trades. And again, that trading involves risks. You could lose money and that you're aware of this before. So read the risk disclaimer carefully. You can find it also on admirals.com, on the website admiralmarkets.com. on the website from Admirals for further details. I don't think, so heading to the next slide, I don't think that I need to introduce Admirals any further because Theo did already an awesome job here in this regard. So what we want to do is we want to head over straight into the current developments when it comes to inflation and also here have a look at right now where we stand in terms of rates. So last month, 6 weeks ago, and this is, by the way, a reason why I want to head over here. So first of all, what we want to prepare for now is the event which takes place on the 16th of March. So here, the Governing Council of the ECB Monetary Policy meeting in Frankfurt. This is the official website from the ECB here. And in this context, what we want to do now is we want to prepare here for this event. What certainly makes sense is to have a look here at what happened last time the ECB met and we saw a rate decision here. So the last time we had these headlines here on CNBC. I just want to scroll through this here, but here are the key points. So the euro area economy is proving more resilient than expected and even avoided a contraction in the last quarter of the year. That was pointed out by the ECB, respectively from ECB President Lagarde. France and Spain recorded growth that made up for the shrinking output of Italy and Germany. So this is something I mentioned already here at the beginning. The thing is that I'm not really sure whether this will last over the course of the next quarters here, and if the growth which we currently see in France, respectively in Spain, will continue to compensate for the shrinking output from Italy and especially Germany. But however, what we know is that currently the economic developments in Germany are a big warning sign, let's say, especially when it comes to the ECB. And given that right now the shrinking output here is compensated for by France, but also Spain, it points into a direction where we say, well, especially Spain depends heavily on a more dovish stance when it comes to the ECB and what rates she's aiming for, let's say. Coming to the last point, meanwhile, the International Monetary Fund upgraded its growth outlook of the world economy here for the first time in a year, seeding China and stable US demand. Let's head over here to the last point. So recession fears subside. Gas storage is up and gas prices are down. Inflation is falling and uncertainty is declining. As such, we have removed the recession from our 2023 forecast. So this is the ECB watcher at Deutsche Bank in this case, Mark Wall. He's saying that. Wall's baseline expectation sees the ECB hiking another 50 basis points. By the way, this is before the decision, by the way. I just realized this. And then also, this is also something which we now see here when looking at the monetary markets. So we also expect another 50 basis points in March, and then another 25 basis points 6 weeks from there. So in May, at the beginning of May, ending up with a terminal rate of 3.21%. And we expect rates to remain on hold until mid-2024. So we don't expect, or at least back then, market participants didn't see the Fed hiking further. This heavily depends on how the inflation development represent itself, I'd say. So what we have here is a chart which I showed you here. So I just sniped it out. And what you can see is in blue, we have the inflation, and then we have the interest rate in this regard here overlaid with the inflation. And as you can see here, so right now we are at 3% interest rate. So this is where we stand right now. And then another 50 basis points to be expected so that we come out. Let's just, by the way, see, probably we can get this interest rate here. So this website is, by the way, really great. It's Trading Economics. So Trading Economics delivers all information for free. I can just share the link here for you. And then also for those watching now the recording on YouTube. Let me just, it's TE, okay, for Trading Economics. And I just share it. So I know share the euro area, so ECB interest rate. You can just click here on Trading Economics, and then you're forwarded to the first page, which we, by the way, will do in a few seconds due to the headline right now. So, but here you can see 3%. This is where we currently stand after the 50 basis points we've seen in February. So we expect another 50 basis points now, which you can see here. By the way, can we? Yeah, okay. Here's the TE forecast in this case. So we don't have a consensus yet. That might follow in the week, next week probably. Then we have around 50 basis points expectation, which will bring us to 3.5. And the interesting thing now will be what will then be delivered in terms of further monetary policy path the ECB will follow. So the main target is to make sure, or to aim on bringing inflation down. So that was something which was emphasized over and over again from Christine Lagarde, also the ECB president here, of the course of the last press conferences. The only problem we have here is that rising interest rates are meaning lots of trouble, especially for weaker countries, economies especially. Like, for example, Italy or also Spain, in my personal opinion. But let's focus on Italy first here. So what we want to do is we want to have a look here at Italy. And I will just give you one thing to think about when it comes to where we have it. Here's the government. And then let's have a look at the debt to GDP. Where we have it there. There's the government debt to GDP. So right now we are bringing this down. But following here the COVID pandemic, especially, there was an explosion on the upside, which brought us to 155%. So that means that the debt to GDP level was at 155%. Let's have a look here at the last 25 years, probably the last 50 years. You can clearly see that there was here, especially following the great financial crisis, a massive increase, a consolidation, and then another push higher. which is, by the way, the main reason why, or where the main reason can be found here at the QE, which was done by the ECB. So a country like Italy was motivated to take on debt, massive debt, to counter also the economic downturn, which was brought on its way due to the pandemic. And and it wasn't very expensive. So it was very easy, in fact, to say, well, we just take on debt and then taking it from there, because it's not costing us that much, because the ECB continues to buy Italian bonds within their QE program, keeping interest rates low at zero, sometimes at a level close to what German paid for its debt. Why is this noteworthy? Well, it has to do with the overall GDP outlook, GDP growth rate. Looking at here, for example, let me just go back here probably. So when you look at the GDP growth rate and you see that there is no such thing as economic growth, or let's say a great economic outlook in general, mainly driven by the fact, by the way, let's go to another aspect here, like looking at the labor sector and looking here at the unemployment rate. Probably that's a little difficult, the unemployment rate, but what's probably of higher interest is the youth unemployment rate. So this is people between or up to, I think, 21, if I'm not mistaken. So you can see that they brought these levels down from nearly 50%. By the way, that was the height of the European debt crisis around 10 years ago. So there was a youth unemployment rate of nearly 50%. So 1 out of 2 people was unemployed. Young people are unemployed. So very simply speaking, you could say, well, if someone is unemployed because companies are not hiring and there's no real positive outlook, economic outlook for the future, no prosperous outlook for the future, well, why, especially within the Eurozone, and why should I stay in Italy as a young person and founding a family and having children, because there's no prosperous outlook, right? So, and if the business model is not given and people are not motivated to stay in Italy then, but leave the country, go somewhere else, well, the country is in trouble, because there's not enough young people coming after the retiring generation, let's say, bringing positive economic outlook, respectively GDP growth in this regard. So simply speaking, so which means the main reason why Italy was capable of taking on all this debt, which will never be repaid, by the way, was only because they were offered a very attractive environment with the ECB buying bonds in unlimited amounts and keeping rates at very, very low levels. Now, with the pandemic, lockdowns, and inflation getting out of control, now the ECB has to make sure that they bring inflation down somehow. How do you bring inflation down? Well, very simple. You hike interest rates. The only problem is countries like Italy right now, and this is something which is pointed out here, only in a small sentence, but it's key, it's crucial, in fact, and it's true for all other economies in the Eurozone as well. So Italy can't take on debt and can't finance their economy the way they did over the course of the last decade. So hiking interest rates to a, let's call it, too high level brings a lot of trouble with it to bring inflation down. And that being said, limits here the chances from the European Central Bank to hike interest rates too aggressively in the future, because they face the risk of letting the Italian economy implode. That's probably a good way to put it. So that being said, means there's not so much room anymore on the upside. Now you might say, well, is it noteworthy? Oh, it is, because Italy is the 3rd biggest economy in the Eurozone. And by the way, now you might say, but we had the same issue, right? We had the same problem also in terms of debt to GDP ratio. Wasn't it about Greece in this case? around 10 years ago. And then we were talking about the Grexit and all that stuff. Well, the big issue, or it's not a big issue, but the difference is that Greece, let's go back here to the more countries and let's have a look at Greece. They were, when it comes to government debt to GDP, just going back so that you have an idea. We are right now at around 145, 148. We're already at 155. So that was this here. That was the height of the debt crisis in the Eurozone. You can see it's very similar levels. It's very similar levels at where we stand with Italy right now, with the big difference that Greece has an economic output which you can compare to one state here in Germany. It's Hesse. So probably you know Frankfurt. So the big capital city in Germany. So this state has the same economic output as has Greece. The thing is, that wasn't, and we already saw how much trouble that caused in terms of let's have a look here back at what we got to see. Do we have it here? No. Let's go to a weekly chart. And we see it here. Yeah, there we go. So that was around here. That was in 2014. That was when we announced, that's probably a little too much. Let's go here that way. That was when we announced, or when it became clear that there will be a quantitative easing. You can see here that was in 2010, around when the European debt crisis came to life, let's say. And there was this sell. We topped out around 150. That was here around 2000, yeah, 250 around, and then we dropped down to 120. So that was also already a massive move. I mean, that was around 20%. Yeah, 20% depreciation of the euro, and we're talking about the most liquid and the biggest currency pair when looking at the euro USD. So this is not an emerging country or something like that. And this drop was already massive. And now, in addition, with also the war in Ukraine, for example, the risk of this spilling over to the whole continent in this case, bears a lot of risks, not just for the economy, because you don't really know what to look for in the future. So it's not a prosperous outlook. You probably, it's not just that you don't trust the overall economic developments and you don't really know what to make out of this war in Ukraine, but in addition to that, you also don't trust the politicians anymore, right? So just look at what happened when it comes to the developments around the COVID vaccines, for example. And now no one really making sure that we understand what happened there in the background, who talked with whom, what were these contracts they worked out about, what was written down there, which is now blacked out when it's presented to the public. And why is no one really willing to give us details, to present themselves in a transparent way, in addition to all the other stuff going on right now, Nord Stream 2, for example, and this potential sabotage act here, September, October in Germany, which is in fact, yeah, it's like a this is like an attack on the German infrastructure, right? So Germany depends on that. No one is in the government right now. No one's really taking care of this and making sure that the public understands what happened there. Who's responsible for that? Well, we all have an idea of what happened there, and because we are, especially us as traders, well, we can put one and one together, and then we say, well, probably this and that is the reason, and this is my thesis behind this. Well, whatever happens there, there's no trust, and once there's no trust in politicians, especially, and in the overall economic developments, well, you don't build a business. You keep things small. You keep your savings at this moment to be prepared once there is an economic headwind you might face, especially if you have a family or something like that. But you don't invest. You're not willing to risk something, and this is a very dangerous environment in which we find ourselves. In addition to the overall developments in terms of the ECB. And so that being said, now coming to the ECB and why all this matters, well, that means there's not so much room for the ECB to deliver a too hawkish, coming back here to the ECB, respectively here, the rate decision, a too hawkish stance when looking into the future. So right now, what's nearly baked in is a 50 basis point rate hike, but what comes after that, that's something which needs to be seen, especially in terms of the used rhetoric from ECB President Lagarde at the press conference. One second, please. I just have to make sure that I update my trading sheet here. You probably have an idea already about what I'm right now going through. So I want to make sure that I'm well prepared for today's trading when it comes to US market opening. After the webinar ends here, I will head over right into the trading action. And in fact, we'll see if there's a chance for me to profit from the current developments. I have two stocks on my radar, by the way. So it's AI. So it's C3.ai company, which delivered a quite strong guidance yesterday, and which is playing in the artificial intelligence sector. And then I have also Zscaler on my screen. And yeah, let's see, probably there's something playing out then. I need to write this down, as you may know, to be able to document my trading afterwards and then review my trading accordingly. But coming back to the ECB, so all that, and in addition to the chart I just came across in the morning, so that really things are getting worse, let's say, especially when it comes to Germany. So what can we have here? What can you see? You see obvious a massive acceleration on the upside when it comes to the declaration of bankruptcies in the EU by activity. So Eurostat here, statistic is official, and you can see there it's total in this case. So this is the, I don't even know, it's a yellow here or something like that. So industry, construction, market services, there's education, health, social activities, transportation, storage, everything shoots through the roof. And this is a massive acceleration, which it's the result out of the restrictive path the ECB is following, because it's not just the overall countries which are affected by a more a restrictive policy path, monetary policy path from the ECB, but it also trickles down to sectors and many businesses, many sectors were kept alive by all the cheap liquidity which was provided with a low inflation environment. And now this cheap liquidity is getting more and more expensive, and there is more and more declarations of bankruptcies, especially those who are working in the growth sector and weren't yet profitable, are right now pushed out of business. And this is what's going on in the let's say in the smaller world. It's not the country world anymore, but it's the smaller landscape we are looking at here. And giving all that and these developments here, making long thing short, the ECB does not have so much room anymore to be more restrictive in their monetary policy approach. The only problem is that right now, inflation is still elevated. Let's go here to the country's inflation rate. And there, let's go here to the euro area. But right now, we see kind of a, let's call it a stall out. That's probably a good way to put it. So what do I mean with stall out? Well, we saw an acceleration here and a peak in October with an inflation of above 10.5%. And from there, now we are coming lower. This is also a development which we've seen in the US taking place, which peaked already, I think, in June or July with over 9% inflation back then. And also here, there's a stall out now. So the cooling down of inflation is not as aggressive as it was now and over the course of the last months, which is probably one of the reasons why equities also shot higher, because this made it more likely that there will be a more dovish stance in terms of the use rhetoric, but also the monetary policy path from the central banks, maybe the Fed, maybe the ECB, for example. But right now, there's more and more signs, especially in the US, by the way, that there's probably a stall out, and that this cool down in terms of inflation is not continuing, which is right now a problem for the ECB, because the ECB could hike rates one end, even though it's limited how much it can she can hike rates, but then also that inflation comes naturally down because people are unsure about the future, saving more, and there's a natural, let's say, deceleration in terms of the, or it's a slower velocity of the money, which is exchanging hands, which is the main driver of inflation. In fact, the more often money changes and the higher the amounts which are exchanging, the higher inflation goes. That's a simple saying, in fact. So, and now we see that inflation is obviously not coming down any further. And the question is, how much more has the ECB to hike rates to bring inflation under control? I think we are far away from that. The only problem is, again, we can't hike further because it's not just affecting big countries like Italy, for example, the third biggest economy in the Eurozone, but it's also now affecting, obviously, here the sectors and the overall economy, especially here when it comes to Germany in this case. And all the unprofitable businesses are going out of business since they can't afford running their business with these elevated, let's call them cash prices any further. So there's hope, let's say. There is some hope, and this is right now we're letting the market balancing a little, let's say. Today in the morning, you can see here, 3rd of March. So today is the 3rd of March. Numbers were released for the producer prices. Producer price change coming in at 15% after having topped out at over 40% already in late summer last year. And so that's certainly very, very interesting, because producer prices, if they come down, so if producers don't have to forward increased prices to the consumer anymore, this is also a sign which is probably bringing inflation down. But said that, it probably takes some moments, let's say months probably, since you can see this effect taking place here at the end of the consumer, beside the fact that a producer here, after going through all these problems with lockdowns and also with increased prices for energy, for example, well, are most likely not to say, well, we cut prices to, let's call them pre-pandemic levels, but instead keep them elevated to make sure that we can now make a profit and let's say live a more prosperous life. So that being said, is it means that the deceleration here, or the cooling down of producer prices, won't be as massive at the consumer front, in my personal opinion, which is also something to keep in mind when it comes to our expectation around what to expect from the Fed in terms of further rate hikes and the rhetoric being used here at the rate decision then on the 16th of March. So how can we put all this together then for our expectation when it comes to the euro and what to expect for the euro? I mean, it certainly depends on what we get in terms of price action now. What you can clearly see is that we topped out, that was around 1 month ago, before we saw the non-farm payrolls coming in at over 500,000 last month. And from there now, trading lower and seeing a corrective move here on the downside, which is bringing us close to this trend line in this case. And the question will be, I could imagine, in fact, over the course of the next 2 weeks, probably till we have the rate decision, that we are probably getting some choppy action somewhere between 105 on the downside and 107 on the upside, some bouncing up and down there, and then getting an impulse, which is, to be honest, difficult to say. Yeah, it's in fact very difficult. I'd probably, if the developments we've seen in the Fed watch tool here around the Fed, if these developments we wouldn't have seen them, then I'd probably say we have a very serious chance of breaking below 105 and heading then for a retest here of the blue moving average, which is the 200 SMA in this case, and can be found around 103 right now. The problem is that right now, the market has already priced in quite significantly a more restrictive monetary policy path from the Fed. So we're not only talking about the euro here, but we are also talking about the Fed in this context and the US dollar. And the problem is now that with the expectations having risen already quite to an elevated level, and what do I mean by that? Well, therefore, I haven't prepared this, by the way. Let me just here go to the Fed watch tool. So since the start of last month, 1 month ago, that was the day when the non-farm payrolls were released. And you could see 1 month earlier, we were at around 450 to 475 basis points. So what you can see here in the Fed watch tool is the expectation of market participants in terms of what will the Fed deliver, or what target rate or interest rate will we see at the given month we are looking at here. So at the end of the year, so in December 2023, what you can see here is that the market right now expects 525 to 550 basis points with a likelihood of nearly 70% in this regard. 1 month earlier, before the non-farm payrolls were released, we were at more than 50% of market participants, 60%, we're expecting 450 to 475. This is, in fact, close to where we are right now. So, in fact, the market expected the Fed to continue to hike rates. So by another 50 basis point, or 25, I'm sorry, 25 in March then at the March meeting, probably another 25 in June. And then cutting rates again, because there's recession fears forming, and thus market participants didn't expect the Fed to hike further, but instead, in the second half of 2023, cut rates. With the employment situation looking as it looks right now, and after the release of the data, and also in addition to the inflation data, which came in, PPI coming in, paid prices when it comes to ISM manufacturing today, 16, so around German time, 4 p.m. German time, 3 p.m. UK. We will have non-manufacturing. If the paid prices component keeps on rising, retail sales being quite strong, in fact. So putting all this together, it doesn't look like a recession forming right now, which meant that market participants starting to anticipate a more restrictive approach then in the second half of the year. The thing is, this is already elevated in my personal opinion, which means the US dollar is mainly driven lower, right, or higher compared to EURUSD, or EURUSD is driven lower, mainly due to the expectation that the Fed will be more restrictive into the second half of the year, which means it is nearly priced in, which means if we are now getting indications or rhetoric from the Fed then, which is not offering anything more restrictive than what the market is currently expecting, chances are given that there will be another spike, or that there will be a spike higher in the Euro USD here in this regard, due to US dollar being under pressure. So that being said, means even if the ECB probably results or comes out and delivers some remarks which point to not an as restrictive monetary policy approach as the market is expecting right now, which is potentially bringing Euro USD under pressure and resulting in a push below 105, it could be quickly bought back the week after, once the Fed then releases her statement on Wednesday, the 22nd, and especially the dot plot, which is probably pointing to a more, let's say, stable path and not a too restrictive path after all the indications which came in right now, which means there could be a flush lower below 105 and then a bounce back. If this wasn't the case, then I'd say, okay, we break 105 and then we are heading lower from there. So this is my current expectation. So putting all this together, coming down to a 30-minute chart probably here. So I expect till the ECB that the market will trade. Let's use this one here. So in this range. So between 107 on the upside and 105 on the downside, bouncing in up and down, up and down. And then the Fed will deliver, the ECB will deliver first. And then there's an increased chance that we are going for an attempt to break below 105. And probably we get to see one. So now it depends a little on which time frame you're trading. If you're a short-term trader and we are dropping 105, then we have probably room for another 2 days, 3 days. So which means the 17th is a Friday, then we have a weekend, 19th, then it's the 20th, 21st, it's Monday, Tuesday. There's further pressure to be expected. And then the deck is reshuffled on the 22nd with the Fed rate decision. So it could be, or what I right now expect is trading within 105, 107, bouncing, bouncing, bouncing. The ECB delivers more dovish than expected because she doesn't have the room to be more restrictive in terms of increasing rate hikes, increasing rates any further, given the current developments, especially in Italy, with the yields spiking in 10-year Italian government bonds, for example, but also in bankruptcies in the overall European economic several sectors accelerating. Given that, it's more dovish stance, meaning a push lower here, below 105, break lower, holding below, probably a trend which will then develop over the course of 2-3 days. And then we have to wait what the Fed will deliver, because then the deck is reshuffled again. And again, if the Fed does not deliver something which is supporting or is already supporting what we currently already know, market-wise, and given what the Fed watch tool sees here in terms of the monetary policy path in the second half of the year, that could mean that the US dollar is sold back at that, and that could result in a pushback above 105, which means once we find ourselves in a trade below 105, shorting Euro USD, the closer we get to the 22nd here, the rate decision of the Fed, the more aggressive we should trail our stop, because chances are increasing that we are getting a spike higher and push back above 105 if we get to see this then in the course of the next days following the Fed rate decision. So yeah, that's it on the Euro USD. Probably it makes also sense to have a quick look here at what the DAX is right now delivering. So we are here at a daily chart. Where do we stand? So as you can see, but probably we go also to a 30-minute chart. So yesterday, I promised you to show you a trade. The reason why I shorted the DAX yesterday was, let's probably scroll over here a little. I've seen this flush lower right from the open, and then the bounce here. So it's a quite aggressive bounce, and we failed to hold here the EMA 50 on a 5-minute time frame. This is my trend indicator. And what I then did was I shorted the DAX here, risking against these let's call them spike highs probably. So risking against 260. I was entering around 230 if I'm not mistaken. And then we saw a flush lower given the inflation. Why the flush lower? Because inflation came in below the month before, but above expectations. So not cooling down as aggressive as expected. This is negative for equities in this case. And so flushing lower from here. But then the market didn't follow through. So no new intraday lows. And once we came back here and we're bouncing again and trading around my opening price, it was like, well, if there was really selling pressure, this push lower here would have brought us new intraday lows and further dynamic on the downside. If this is not the case, and I'm not getting the feedback as I expected once I entered the trade, well, I'm out. And it was a good decision because I think 10 minutes later or something, we spiked here to my stop level. So that was a short loss, a small loss, probably something like 5-10 points, I don't know. And then we kept on stabilizing and took off from there. And so it's not just that we took off from there, but also, as you can see here, we're now pushing to the intraday highs. And the question now for the on weekly close is whether we can hold here above 500, 550. So right now you can see it's quite extended. And that means what I'm talking about here is the dependent. So we are dependent on US equity markets. If US equities push us or help the DAX to capture that level, and if we hold this, I think then there's a serious chance, probably today, probably next week, that we get to see an attempt to break to new highs here, new yearly highs. And once this is achieved, well, there's no further room on the upside, where there's no real resistance on the upside. It seems likely that the DAX is about to see new all-time highs quite soon, in fact. So, and this could be triggered by a more dovish stance from the ECB. All I formulated just a few minutes ago, which is potentially driving the euro lower, even though it doesn't necessarily mean that we're dropping significantly below 105 due to the fact that it's a currency pair and the Fed is also playing a role here. It is all in all bullish for equities. So once we see such an approach here, and the DAX is pushing here above 15,600 points, there's probably, from an options perspective, there's a potential target to be found around 15,800. But above that level, there's no resistance anymore. So 16,300, 16,500 seems very likely. So and to be honest, what we're currently facing here is also quite strong. So given the fact that there's a more restrictive policy path expected, and the DAX can withstand any pressure, any seller pressure over the course of the last 2 weeks, especially, and also Wall Street is holding quite nicely. This is a sign, in my opinion, of relative strength. And so that being said, bullish breakout seems likely. If not today, then probably next week. And especially after this price action we've faced here now over the course of the last hours, last trading day, in fact. So choppy action in Euro USD, not just in the course of the next 2 weeks, but also after the ECB, even though with a short spike below 105, which seems likely, while the DAX should be considered bullish, in my personal opinion. So I hope you enjoyed this, and I hope you can make something out of this. Let me just, by the way, head over here once again to the presentation and share this slide. So if you have any questions, if you want to contact Admirals, then please find your preferred way of doing so. Subscribe to the YouTube channel, by the way, if you're watching this on YouTube. You can also ask your questions in the comment section below. Also Facebook, I think all social media channels were already mentioned by Theo. And again, also simple one, go via email if you have any questions, shoot them over. And that's it from my end. So all the best, happy trading. Watch the stops. Talk to you again then next week. Then with the non-farm payrolls release will be very, very exciting. See you then. Happy trading. Watch your stops. See you.